I'm gonna get right started here. I don't have any sales pitch for you guys. I don't have any programs or classes or anything for you to sign up for. So from this point on, I am just offering uh, content. And I've been told when you do these kinds of things that you should do 80% ice cream and 20% broccoli. And it's not really my style. So for better or worse, I'm going to give you guys a lot of broccoli and really talk just about a lot of the nuts and bolts of this stuff and not a whole lot of fluff. So let's get right into it. It's going to start with mandatory disclaimer because we're lawyers. So this is not legal advice. You're not paying us for legal advice. We're not creating an attorney-client relationship from this presentation. This is just for your information so you have a working idea of what syndications are and how to put them together. And if you'd like to continue with us and form an attorney-client relationship later on the road, we'd love to have you. But that's my disclaimer. So take that. So let's jump right in. What is a syndication? And very simply, a syndication is just pooling investor money to make a specific transaction. So this is different from a fund, for instance, where I'm pooling money, and once I've pooled a whole bunch of money, I'm going to decide what transactions to make or what things to buy. I've already identified something that we're going to purchase, usually real estate. It might be a piece of art. It might be a sports car that we're investing in, hoping it appreciates, something like that. But we've already identified the object of our transaction, and now we're going to raise money to make the transaction happen. And all syndications have what are called sponsors. The sponsors are the people in charge. They're the active participants. They're the ones identifying the opportunities, making all the connections, and making everything work. And everybody else that comes in the deal is a passive investor. Passive investors pretty much just put in their money and they sit there as houseplants. So the good side of that is passive investors have limited liability. The bad side of that is they have limited authority. So if you're investing in one of these deals, you don't get to dictate a whole lot about it. You don't get to tell the sponsors when they're going to sell or at what price. You're just investing with them and trusting them to make good decisions with regards to the transaction. So just to give you a structural idea, I want to start first just kind of outlining a basic real estate transaction. Now, these don't have to be real estate. It could be really any kind of investment. Just real estate is kind of my playground for the most part. So a basic real estate transaction would go like this. We have an apartment or self-storage or house or something we want to buy. I form an LLC to hold that asset. And then I or me and my partners become managing members of that LLC. And so we're going to put our money and we're going to exercise control over that LLC. The LLC in turn is going to buy the apartment or whatever it is. Super simple. Okay. Now, if we want to syndicate, because maybe I and my partners don't have enough money to take down this huge apartment, what we're going to do is we're going to split up the roles a little bit. So instead of a managing member that's going to control the LLC, we're going to put a manager on one side, we're going to put members on the other. The members are going to put their money into the LLC. The manager is going to exercise the control. So we've split our roles a little bit. And then the LLC, like before, is going to invest its money in the property. Now, in reality, this manager is really going to be an LLC. So then we have our sponsor who's going to control the management LLC, which is going to control the single purpose LLC that's going to buy the apartment. And like before, members put in their money, sit there like houseplants and hope to make money. Okay, keep that in your mind for just a minute and let's switch gears and talk about securities. What is a security? Congress did a really good job. They made this abundantly clear. It's so simple. This is, yeah. I have no idea what this is. This is what the Securities Act says is a security. It looks like a bunch of gobbledygook. Plaintiffs and defendants and regulators throughout the years have had very, very difficult time with this definition. So fast forward a few years after the Securities Act, 1946, Supreme Court heard a case called SEC versus W.J. Howie Company. And the big issue in that case was what actually is a security. And the Supreme Court came up with a 4-factor test. They said a security is an investment of money into a common enterprise with an expectation of profits from the efforts of others. Investment of money, common enterprise, expectation of profits, efforts of others. 1, 2, 3, 4. If you don't hit all 4 of those, you are not a security. So for instance, Kickstarter. Kickstarter is crowdfunding, but it's not crowdfunding in the sense that we talk about crowdfunding. It's not raising equity for a company. Kickstarter, there's no expectation of profits. So in putting money in Kickstarter is not a security. Trading sweat equity for a stake in a company is not a security because it's not an investment of money. Buying maybe a nice watch, hoping that it will appreciate and be more valuable in the future, not a security because the money's not made off the efforts of others. So if you don't hit all 4 of these criteria, then you're not dealing with a security. Now, I think there's an even easier way to identify security than the Howey test. And I've come up with just 2 criteria you can look at. And that is, it's a security if it's an intangible passive investment. That's all we need to know. So let's look at things that are securities: stocks and bonds, annuities, notes, oil and gas, LLC membership interests. Those are securities. Those are intangible passive investments. You put your money in, there's nothing else to do. You can't touch them. This is as opposed to things that aren't securities, like houses, apartments, cars, fine art, gold bars. Now, a tricky one is cryptocurrency. I think the jury's still out on cryptocurrency, whether cryptocurrencies constitute a security. On the one hand, they're a medium of exchange. They're a currency. On the other hand, people are tending to treat them more like stocks or futures, and they're just buying them as speculation, trading them like futures or whatever. And I think the jury is really out long-term as far as whether cryptocurrencies are going to squarely fall into securities or non-securities camp, but we'll see. Anyway, but that should give you an idea. The things on the right, other than cryptocurrencies, are things at least that you can touch, that the value in them comes from their existence, not from someone doing something the way that, say, annuities are or oil and gas royalties are. Okay, so let's go back to our syndication structure. And just take a couple seconds and look at this diagram and see if you can figure out where exactly is the security in this transaction. You got it? Okay, it's right here. Why? Because this is an intangible passive investment. Or if you want to look at it as the Howey test, it's an investment of money into a common enterprise with an expectation of profits off the efforts of others. Squarely a security. Okay, now why do we care? Well, because selling securities is illegal, except when it's not. So what we've got here is just classic government. Government came in with the Securities Act and said all securities offered in the US must be registered with the SEC and applicable state regulators. So classic licensing scheme where the government takes away your right to do something and then sells it back to you. Now, securities regulation is very, very expensive. Hundreds of thousands of dollars. It's probably a 6 to 12 month timeline. For most deals, the expense and the time is going to be a complete deal breaker. Registration, it just most of the time is not even on the table. Fortunately, they did build in some exemptions. So you either have to register with the SEC or you have to qualify for an exemption. And the big exemption that is in the Securities Act is transactions by an issuer not involving any public offering. Okay, well, that leads to the question, well, what's a public offering? And I remember you know, being a little kid and learning words and asking my mother, well, what's the public? I heard this word public. What's the public? And she said, well, the public is all of us. It's people. So we don't have to register our securities as long as we don't offer it to people. Well, okay, that's not very tenable, right? So Supreme Court came back again in the 1950s in a case called Ralston Purina, where the company had been selling its stock to its employees. And the SEC said, wait a minute, you're making a public offering. They're like, this isn't the public, this is just our employees. It's private, right? And the Supreme Court looked at it and just basically determined, well, what's the public in public offering? And what they came up with was the public is people who need the protection of the Securities Act. In that specific case, they decided that the employees actually were the public because they didn't have the information that they would have gotten had the securities been registered. And so selling even to their own employees was considered a public offering. All right, this is still kind of wishy-washy and still kind of hard to tell. Am I doing a public offering? Am I private enough? Have I narrowed my scope of investors enough? So we fast forward a few more decades and we've got SEC regulations, we've got the Jobs Act and recent changes to the Jobs Act. And now we have the SEC and they've given us, among other things, they've given us 4 kind of principal regulations that we can shelter under to avoid being considered making a public offering, even though we're not technically registering with the SEC. So we got Regulation CF, and Regulation CF, it was a $1.07 million maximum offering limit. They just raised it March 15th of this year to $5 million. You can raise $5 million from any investor with certain limits based on the investor's income or net worth. You are, however, restricted to selling your securities only within an online portal that's been registered with FINRA. So there are some complications with it. There's some hoops you got to jump through, but that is one regulation that's available to CF Crowdfund to crowdfund your securities. Another one is called Regulation A. And Regulation A is kind of a quasi-public offering or IPO light, I hear people say. It actually it's not registered with the SEC, but it is qualified by the SEC. And there is some back and forth interaction with the SEC before you're allowed to sell your securities through Regulation A. But if you get through that process, you can raise up to $75 million. Again, just last week, just March 15th of this year was raised to 75 million from 50 million. You can raise up to 75 million, again, from any investor. It's a long process, not as long as registration, but it's still going to be 3 to 6 months. It's very expensive, not for everybody, but it is an option that's out there. Regulation D, in my opinion, is the creme de la creme. It is the best of all of these, and that's the one I'm going to focus on in the next several slides. And then Regulation S. Also a very good one, but that is for raising money from non-US individuals. So non-US individuals in a sense are not considered part of the public that the Securities Act is trying to protect. So Regulation S is a great option if you're raising money overseas. Sorry for my notifications. I did turn them off, but they're still making noise. All right, let's talk about Regulation D, because 90% of the matters that I deal with, Regulation D is the most appropriate vehicle for raising their money. And Regulation D has several rules you can operate under. There's 2 main ones that are the most popular. They're called 506B and 506C. And very similar rules. 506B, what it does, it allows you as the issuer, as the sponsor of the syndication, to raise an unlimited amount of money from an unlimited number of accredited investors. I'll talk about the definitions here in a minute, but for the time being, accredited basically means well-to-do, rich, or what a lot of us would consider rich. You can have up to 35 unaccredited but sophisticated investors. And the catches are you must provide certain investment disclosures. Those come in the form of what's called a private placement memorandum, which is kind of like a prospectus. And general solicitation is not allowed. You can't go on your Facebook or your Instagram and talk about your deal. You can't put up billboards and say, come invest with me. So generally what you need is a pre-existing substantive relationship. Again, definitions I'll get to in a minute, with all the people that you offer the opportunity to. Okay, so that's 506B. 506C also allows you to raise an unlimited amount of money from an unlimited number of accredited investors. Now, your accredited investors in 506C have to be verified by a third party. So typically you'd have them take a form to their CPA or their tax advisor to sign off that says, yes, they are accredited. There's also services out there that will do it for a fee, usually $150 per investor, to verify that an investor is accredited. You're not allowed to have unaccredited investors, accredited only. But the trade-off for that is general solicitation is allowed. You can go on Instagram and Facebook and all those places. If any of you follow Grant Cardone, who's got a huge social media presence, he has been regularly running ads, putting up posts that say, if you got $250 cash, come invest with me, contact me, get in my deals, buy apartments with me. What he's doing is a 506C offering. He's generally soliciting, but only accepting accredited investors. Okay, so the next question is, well, what does it mean to be accredited? Well, as far as it goes for an individual, if your income is $200,000 a year, it has been for the last 2 years, and you expect it to be for the current year, then you're accredited. You can also combine your income with your spouse, and if that's greater than $300,000, you'll be accredited. And just at the end of last year, in December last year, they added spousal equivalent. So you no longer even have to be legally married to combine your income. If you have a domestic partner, someone that you live with that kind of takes the place of a spouse, even though you don't have the marriage license, you can still combine your income with them to qualify as an accredited investor. Alternatively, if your combined net worth with your spouse or spousal equivalent is more than $1 million, you're accredited. Now, this does not include positive equity in your home. So you could have a $10 million equity in your house, but if you don't have any other assets, you are not going to qualify as accredited. Your positive equity in your house does not count. Negative equity in your house does count. So if you're upside down in your house, that's going to count against your net worth, but any positive equity in your home does not count towards it. So keep that in mind. And then again, with the changes they just made in December, you can also become accredited if you have certain professional credentials. And the specific ones they've identified are financial related credentials, Series 7, Series 65, and Series 82. Ironically, being an active securities attorney is not sufficient to be considered accredited or to be just deemed smart enough to invest in these deals. So, we can advise on these deals, but we can't qualify by the fact that we can advise on these deals. Okay, so those are the ones for individuals. Certain entities can also qualify as accredited if they have $5 million in assets or more, and they weren't formed for the purpose of investing in this opportunity. They just added family offices, certain trusts, lots of institutional type investors can qualify as accredited. I'm not going to get into all the details there, but there are alternatives. If you're not accredited as an individual, perhaps through a particular entity, you can be accredited. Okay, if you're not accredited, you can't do a 506B offer. You can't invest in a 506B offer, a 506C offering. You might be able to invest in a 506B offering, however, because 506B allows the unaccredited investors as long as they're sophisticated. So what does it mean to be sophisticated? Well, the regulation says you have to have the knowledge and experience in financial and business matters such that you're capable of evaluating the merits and risks of the investment. In other words, you're smart enough or educated enough or experienced enough to know what you're getting into and to know the risks you're taking. If you don't have that, don't fear, because you can also borrow that from someone. You can have a purchaser representative, quote unquote, that can basically qualify for you. So if you have a purchaser representative that has knowledge and experience and they're capable of evaluating the risks, you can rely on them for your own sophistication. Now, purchaser representative can be anybody that meets that criteria as long as they are not, basically not a major player in the deal. If they're unrelated to the deal, or if they only have a small stake and they're not related to the sponsor, they can be your purchaser representative. Okay. Now, being sophisticated is only part of the equation in 506B, because you also, because you can't solicit publicly, you have to have a pre-existing substantive relationship with your investors. So what does it mean to have a pre-existing substantive relationship? Pre-existing is fairly simple. It means the relationship existed prior to the commencement of the offering. And commencement of the offering is not really defined, but the safest bet is to say, as soon as you start talking about your offering with anybody that's not part of the sponsorship team or your professional advisors, that's probably when you're going to be deemed to have commenced it. Maybe that's a bit conservative, but I'd much rather be conservative than risky as far as treading on securities violations. So err on the side of a little bit early. But prior to now, there is no waiting period prior to the commencement of the audit. You could meet them the day before. You could meet them an hour before. The SEC has said, and there's a address to this website on the SEC's website where they've answered a lot of these questions. There is no minimum waiting period. You don't have to have a 30-day waiting period before you can show someone an offering. But you do have to establish it before you commence the offer. Okay. The more important part of that, in my opinion, is the substantive part. What does it mean to have a substantive relationship with somebody? And that is, substantive relationship is not, you know, they come over to your house or barbecue. It's not your kids are in ballet together or anything like that. Substantive has to do with a financial relationship, a financial understanding. And what the SEC said is your relationship is substantive when the issuer has sufficient information to evaluate and does in fact evaluate a prospective offeree's financial circumstances and sophistication. So my brother, for instance, is a roofer, a rehabber. He's around real estate circles a lot. I have no idea how much he makes. He drives a nice truck. I'm guessing, you know, he does pretty well. But frankly, I don't know his financial circumstances, and I don't know how well he would understand, for instance, a multifamily syndication. I don't know if he knows what cap rates are or whatever. Do I have a substantive relationship with my brother? Jury might be out on that. I probably do. But I couldn't tell you for sure what his financial circumstances are. I might know enough to meet the bar here, but it's a little bit gray. Okay. So what if I'm skirting the line a little bit? What if I'm not totally sure I have this substantive relationship with someone? Well, we've got kind of a safety valve here, and I'm getting into a little bit of gray area, so don't go overboard relying on this. But the SEC said, and this is on the same this website down at the bottom of the screen is a kind of a question and answer thing that they've published. And they said a pre-existing substantive relationship is one means, but not the exclusive means of demonstrating the absence of a general solicitation. For instance, they say that if, an informal personal network of individuals with experience investing private owners might be sufficient. If you're involved in, say, an investing club, you might be able to rely on introductions through that club to establish a relationship such that offering someone in that club security wouldn't be considered public solicitation. Be careful with that. The language there is a little wishy-washy, but it at least offers somewhat of a safety net if we can't definitively establish that we have a pre-existing substantive relationship with our investor. Okay, bottom line here is, and this is again quoting from the SEC, In general, the greater number of persons without financial experience, sophistication, or any prior business relationship with the issuer that are contacted by an issuer through impersonal, non-selective means of communication, the more likely the communications are part of a general solicitation. If you're posting on Facebook, if you're spamming, using Instagram, cold calling, you're probably crossing the line. If you're doing a 506B offering, be very, very, very careful that you are not indiscriminately showing people your offering. Okay, let me roll on. When you do a securities offering, you're going to have to come up or have an attorney come up with offering documents. You may have seen these. They're just enormous stacks of paper with tons of legalese and all kinds of disclaimers and doom and gloom. Very important things to have as an issuer, very important things to have as an investor, to make sure that everybody's on the same page about what's going on. So real briefly, let's just talk about what constitutes our offering documents. The primary piece is going to be the PPM, the private placement memorandum. If you're using Regulation A, it's called an offering circular. If you're using Regulation crowdfunding, it's called an offering memorandum. Basically the same thing. This is the document that's going to tell you about the deal, who are the sponsors, who's responsible for what are the fees, how do distributions work, and probably most important, what are the risks involved in getting into this investment. If it's real estate, they're going to talk all about possible changes in the real estate market, interest rates, supply and demand, all those kinds of things. Eviction moratoriums are a hot thing right now because of the COVID-19 pandemic. All those things are going to be disclaimed and disclosed in the PPM. And if you read the PPM, you take it too seriously, you probably never invest in anything. But this is where we're just telling you, here's everything that could possibly go wrong ever. Okay, then we'll have an operating agreement. The operating agreement governs or explains how the company is going to be governed. How does voting work? Can I remove the manager if they're doing a bad job? How do distributions work? What percentage of the profits can I expect to get as an investor? Do I have a preferred return? Are there a bunch of fees? Does the manager have a salary? Things of that nature. Those are all going to be in the operating agreement. And really the operating agreement is probably more important than the PPM, because the PPM is really just about the offering of the securities up front, whereas the operating agreement is going to govern the entire deal for the entire 5 or 10 years or however long your investment's going to be tied up in it. Then we'll have a business plan and a pro forma. This is where the unicorns and rainbows and all the fluff is. And, oh, here's our projection of how much money we're going to raise and how great this is going to be and all that stuff. So all the things that we disclaimed and said, wait, you don't, pay no attention to this stuff in PPM is what we're putting in the business plan. So the business plan is all the bright, sunny stuff. Then there'll be an investor questionnaire. This is for investors to represent that they're suitable, either demonstrating that they're accredited or that they're sophisticated, that they're not investing a significant portion of their net worth, that they understand the risks, things of that nature. And then finally, the subscription agreement, where you're going to sign and say, yes, I've read all the documents. Yes, I understand. Here's how much money I'd like to invest. Sign my name. And that's really all there is to it. That's my presentation. I'll open it up for questions. If you'll type questions in the Q&A box, I'll have Kaylee come on right now and start reading those. And that's all I have. Here's my contact information. And thank you guys so much for showing up on a Wednesday afternoon and listening to me gab.
All right. So one of our first questions was, can you give examples of giving investors a 15%, is that IRR? Yeah, on a deal?
Can I give examples of giving investors a 15% IRR on a deal? I'm not sure I understand the question. If, a deal can spit off enough cash flow and enough return on the back end, it might achieve a 15% IRR. I'm not really sure what that question's getting to.
Okay. For sponsors doing their first regulation crowdfunding fund at $1 million, what terms do you suggest that are attractive to an investor? Fees to charge, lockup period, IIR, first straight reference, etc.
That's really going to depend on the nature of the investment itself, and certain terms are going to be attractive for certain types of investments and not others. A ground up construction deal, for instance, is not going to be attractive with the same terms that, say, a stabilized apartment investment is going to be. At the end of the day, the terms you come up with are frankly whatever your investors will accept. If you're too greedy and you take too many fees or too big of a split, no one's going to want in your deal. If you take too little, then the deal's not really worth you doing because you're not going to make any money. So it's really going to be on a case-by-case basis how you structure your deal and what you charge. You really need to know who your investors are, even before deciding between, say, regulation crowdfunding and Reg D. A big determinant of that decision is who are your investors and how do you need to reach them. So those are all things that have to be taken into account. It's hard to give a definite answer, on a webinar without more info.
Another question we have, does an inactive Series 7 qualify as an accredited investor?
No, has to be in good standing. There is an email address. So if you're unsure whether a credential you have, so they've identified those 3 series credentials. If you have another credential or some other circumstance that you think should fall under that, there's actually an email address on the SEC's website. I don't have it handy, but if you search on sec.gov, you can find it, where you can actually email them and say, will this work?
All right. And then Eric asked if they had a securities license, but it is now lapsed, would that still qualify as an accredited or as accredited?
That's basically the same question.
Okay.
What they've said is it needs to be in good standing. And I think if it's lapsed, it would not be considered good standing. But again, you can contact the SEC and ask for a thumbs up or a thumbs down.
Who needs to be licensed? Sydney?
So the license that's most often looked at or talked about with regard to issuing securities is a broker-dealer license. And you're supposed to have a broker-dealer license in order to sell securities. However, there's what's called the issuer exemption. So if you are part of the issuer, the sponsor, you can raise money on behalf of the syndication that you're sponsoring. You can't take a commission for raising the money. You can't be compensated based on how much money you're bringing in. And you have to have other responsibilities to the company after the offering, other than just simply raising money. But as long as you meet those criteria, you don't have to have the broker-dealer license.
Okay, can you put together a lead magnet to collect contact info to start a relationship?
Yes. As long as you don't have as long as you haven't commenced an offering, you can meet people, network with people, have websites where people sign up and give you their information, fill out questionnaires to talk about their sophistication. The problem starts when you already have something to sell them, because then your relationship is no longer pre-existing.
All right. Can investors sell shares in their investment?
In certain circumstances. So it really depends. Under Reg D, it's fairly tricky. Under Reg A, you can, although there may not be a market for them. So it varies based on what exemptions you're relying on, whether your investors can turn around and resell their securities. In most cases, no. In most cases, when you're syndicating, your investor's investment is illiquid, and they're along for the whole ride. But not in all cases.
Okay, and then Victor's wanting to know, what are some of the better, maybe 2 or 3 crowdfunding sites to use?
Wow, that's a difficult question. A lot of our clients have been using CoreConnex, which has a portal as well as acts as a transfer agent. There's a handful of others. I don't really have a good recommendation for which ones. Some issuers even make their own. So as long as you're not doing CF, you can make your own platform and sell your securities on it.
All right, and then Cindy's wanting to know if we can explain bird dogging fees.
I'm presuming you mean finder fees. Finder, as it stands right now, you can compensate someone for making introductions to investors. But that's all they can do is make the introduction. They can't talk about the deal. They can't solicit the investors or try to sell them on the idea. They can only make introductions, and you can only pay them for introductions. You can't pay them for an amount of capital invested or anything like that. There is a proposal to change that. It is probably a long ways off, where you actually could, in certain circumstances, pay finders, and finders could actually do some limited marketing on your behalf, but that we're not there yet. So finders fees are okay. You do have to comply with state law. So certain states have finder requirements. Texas, for instance, you have to register to be a finder. So talk to an attorney and see what you can and can't do in your specific state. I think you're muted, Kaylee.
Sorry. What about a Reg S? And can you talk about how the offshore transaction would work and how much it would be to set up?
Reg S is very, very simple. As far as securities are involved, you can raise money from non-US individuals. And that's really all there is to it. There's not even notice filings and things like that we have with Reg D, for instance, and Reg A. So very, very simple. Now, there are other tricky things with foreign investors, for instance, taxation, repatriating money, the anti-terrorism and anti-money laundering provisions. Those have to be complied with. There's going to be securities laws in the nations you're raising money from. So there may be, depending on the nation you're soliciting in, there may be issues over there. As far as the SEC and just in the box of securities law, Regulation S makes it about as easy as you can make it to raise money.
Do you ever work with preferred equity or mezzanine debt companies?
Yeah, we do.
Can the exceptions discussed be used for a fund versus a single syndication?
So with certain exceptions. So for instance, Reg A, you can't do a fund unless it's real estate. But Reg D, you can do Reg D offerings, you can do funds. Reg S, you can do funds.
Do you also assist with creating the LLC and reviewing the PSA?
We do assist in creating the LLC. Reviewing the PSA is a little trickier because then we're getting into more state law type issues. So if one of our attorneys is licensed in your state, then happy to review a PSA. But typically, in some cases, we're dealing with, like Texas, for instance. I do a lot of real estate transactions and deal with PSAs and title commitments and all that jazz. but I'm only licensed in Texas. We have a few attorneys that are licensed in various states that can help with that depending on where you are.
And is there some limited number of accredited investors one can have in a deal whereby you don't have to do a PPM?
So under 506C, technically you don't have to do a PPM, but I would highly, highly recommend it because the PPM really covers your butt as far as making disclosures and being transparent with your investors. So personally, I wouldn't be comfortable doing an offering without a PPM or just a similar disclosure document, but you can.
Tom is wondering what a typical timeline of this looks like.
Again, depends on the regulation you're relying on. Reg Ds are probably the simplest, Reg Ds and Reg Ss. So on a Reg D offering, usually 2 to 3 weeks, we can get your offering put together. I try my best not to be the bottleneck. And if you're syndicating, for instance, a piece of real estate, you're going to get under contract, you're going to start working on your offering, but you're also going to be doing due diligence on the property. And so it still might be a week or two before you have all of your pro forma materials put together, your business plan, before you know what your capital expenditures are going to be. So I try my best to be waiting on the client to get that stuff done rather than have the client waiting on me to get the offering done. Most of the time I'm successful.
And we have someone wanting to know if you are in Texas, can you do a California syndication?
Yes. Because all these exemptions that we're talking about are under federal law. So.
And the big question, what's all this going to cost?
So Reg D offerings, our fees are we do flat fees for the offerings, but they're based on the maximum amount of capital raised. So it's going to vary generally between $10,000 and $50,000 depending on how large of an offering you're making. It's on a sliding scale that gives you more bang for your buck as you raise more and more money, but the price does change based on how big of an offering you're doing.
And then someone was wondering if you could elaborate a little more on rolling up a CF deal into an upright.
Sorry, you cut out a little bit. Can you say that again?
Upright.
I don't know what an upright is. Whoever asked that question, if you can email us that email address on the screen, we'll be happy to look into that for you.
At what point or under what situations might you recommend a fund versus a syndication?
So a syndication generally is going to be a lot easier to sell to investors because you have a specific thing that they are putting their money in. They can look at it. They can, if it's an apartment, for instance, they can drive by the apartment and, see whether it's in a crappy part of town or whether they think it has a lot of potential. Whereas a fund, you're really just selling an idea. You're saying, well, I'm going to buy Class B and Class C apartments in maybe one of these 3 markets, and it might be 50 to 150 units, and it's really wishy-washy. So unless you have a large pool of investors who trust you to make really good decisions that they don't need to see the specific deal before giving you a lot of money, then you're going to be a lot better off syndicating. If it's your first rodeo, I probably definitely would syndicate before trying to do a fund. Maybe if you have the network of investors under you, or if you have a partner with a big network of investors, maybe you could start with a fund. But it's definitely going to be a tougher sell, all things being equal.
And another question we got was most crowdfunding or CF funding portals approved by FINRA are unprofitable. Do you believe this will change going forward and becoming a funding portal is generally a good opportunity?
I we'll see what happens now that they've raised the offering limit. When it was only $1 million, it was a really tough sell to say, well, you should jump through all these hoops and deal with all these, different, things that you have to deal with. Audited financials, for instance, which are not cheap. To only raise $1 million was kind of ridiculous. 5 million, it's a little better. So we'll probably see more CF offerings start to come through the pipe. I kind of hope in the future that they'll relax it even more and maybe start letting people raise bigger amounts of money. They've broadened it a little bit as far as how much money also you can do. There's some test the waters activities that you can do now. The limitations on how much a particular investor can invest have changed and become a little more liberal. So we'll see what happens. I think it'll get better. I don't know whether it's going to make, whether it's going to be revolutionary or not. We'll have to see. It's only been a week. So sit back and watch.
So could you do a 506B with only sophisticated investors as long as you stay below 35?
Yeah, absolutely. And more often what I see is that someone will do a 506B and restrict it to accredited investors. So, if they have the accredited investors in their network where they don't need to publicly solicit, they could raise money only from accredited, but not have to do that independent verification. So I see a lot of deals like that. I don't see a lot the other way around where people are only sophisticated. There's not really an advantage to raising money from sophisticated investors versus accredited investors. Sophisticated investors or unaccredited investors are the people that the SEC is more interested in protecting. So there's a little bit more scrutiny on a deal that's got unaccredited investors versus one that has only accredited investors.
And Brian is wondering if foreign individuals can be accredited investors.
It doesn't matter. They don't have to be because they're foreign, and so the SEC doesn't have really an interest in protecting them.
And Mike wants to know what the best kind of crowdfunding for a specialty restaurant.
Again, I think it's going to have a lot to do with who your prospective investors are. Primarily, and secondarily what type of business it is. I think that just my kind of feeling about Regulation A and Regulation CF is those are going to be better for like sexier type of deals, and kind of the tried and true Reg Ds are going to be better for the more like boring, straightforward, cash flow real estate type deals. Obviously there's exceptions. Grant Cardone did a very, successful raise with Reg A for cash flow multifamily. But he had the investor pool of Joe Everyman small ball investors that could fill up, a $50 million deal. You may or may not. So there's more to it than just the type of business that you're raising money for.
Does it matter if investors are from a single state versus investors from multiple states? For example, each state has different rules, so should we focus on investors from one state?
That's a really great question. When you do a Regulation D offering, there is a securities notice filing in every state, just about every state that you raise money from. A handful of states don't require it, but most states do. And so you have to send a notice first to the SEC. Hi, I'm raising money. Here's my maximum raise. Here's how much money I've already raised. And then to every state securities regulator, you have to send a notice that says, hi, I'm raising money in your state. Here's how much I've sold so far. And each state charges a fee, generally a few $100s. Texas will charge up to $500. New York is over $1,000. But most states are a few $100. So, that it's not an onerous amount of money, but it does add up if you have a large array of states you're raising money in versus like one state. Now, if you were staying only in one state, there's also actually some opportunities where you could raise money just using state securities law rather than one of the federal exemptions. And we do those occasionally, not too often, because Reg D is pretty easy to deal with generally anyway. So most of the time you don't even need to. But if you're just in one state, you've got a few more options for raising money too. And with that, I guess we'll wrap it up. Thank you everyone for attending. I can't believe the turnout that we had. It's much more than I expected. And we will try to have the replay of this posted up on YouTube and Facebook and all the other places we can very soon. Thank you all very much.